Welcome to the Employees Group Insurance video on the Health Savings Account, or the HSA. The purpose of this video is to help you decide if you want to participate in an HSA. We will touch on the High Deductible Health Plan, or HDHP, too, as it's required for a health savings account. We will also touch on the Wraparound Flex account, as this account is also available to those with the HDHP. We suggest you also watch the health insurance and flex videos for additional information. As mentioned, in order to participate in a health savings account, you must be enrolled in a high deductible health plan. A health plan can only be called a high deductible health plan if it meets the IRS guidelines. There are some very specific differences to be aware of with an HDHP plan versus the other regular plans. Unlike the regular plans, which have individual and family cumulative deductibles, the HDHP plan is either a $1,600 deductible for the employee only or a $3,200 deductible for employee plus dependents. On the HDHP plans, one person could meet the entire deductible. Also, unlike the other plans which do have office copays, the HDHP plan does not have any copays associated with office visits. All costs will apply to the deductible and coinsurance. Next, prescription coverage is part of the major medical plan, which means there are not copays. Rather, you will pay the cost for the prescription, but it will be applied to your deductible. After the deductible, your prescriptions will then be paid at 80% by the plan, and you will pay 20% until your yearly out-of-pocket max is met. There is a difference as well regarding colonoscopies. They are covered at 100% of the maximum allowable cost if the diagnosis is preventive. This means that if they remove a polyp, it becomes medical and is subject to the deductible and coinsurance. As mentioned, when you enroll in the HDHP plan, you are eligible to participate in a health savings account, or HSA. The state plan also offers a wraparound medical reimbursement account, a flex account, when you participate in the HDHP. They are voluntary and just tools in your toolbox that you can choose to participate in or not. You can choose to participate in one or the other, both, or neither. Both account types are pre-tax money to be used for specific qualifying expenses. There are pros and cons to each option, which we'll discuss further. Be sure to read the Flexible Benefits book for wraparound information and visit irs.gov for HSA information. An HSA is a specific type of account you open with your bank or financial institution. You elect how much money you want deposited monthly into that account. You must not exceed the IRS limits per year. These funds are pre-tax funds you can use later for qualified, IRS-allowed expenses. You would use checks or a debit card from that bank to pay for those expenses. This option is good because you do not have to submit a claim to be reimbursed. The funds are used at the time of service. However, it is a bank account, so you have to have the funds in the account or the bank would charge you insufficient fund fees. Also, the HSA account is not a use it or lose it account. The money continues to be available to you whether or not you use it. As a reminder, you cannot contribute to an HSA if you are on any other health plan which is not an HDHP. For example, a secondary coverage through a spouse or a parent. The Wraparound Flex is different than the normal so-called Apple Flex account you may have used in the past. It may be helpful to also watch the Flex video on our website for further information regarding Flex accounts. The Wraparound account has a lower IRS allowed amount that can be deducted from your paycheck on a pre-tax basis. Claims must be submitted by the employee to EGI for reimbursement. This plan is for things such as vision, dental, orthodontics, etc. If the claims fall under health insurance, including deductible, coinsurance, or prescriptions, they are not eligible for reimbursement. This account is a use it or lose it account, so if you are unable to claim the money within the yearly deadline, you will forfeit the money. Let's compare the HSA and the Wraparound Flex. Both options are pre-tax payroll deductions. The Flex account has a lower IRS limit per year. Both are subject to the current year IRS limits. The Flex account is a use it or lose it account. If you cannot or fail to claim the money, it is forfeited, whereas the HSA money rolls to the next year. It is not lost if you do not use it in the same year. This is very important. The wraparound Flex is very different from the regular Flex you may have used in the past. This account will only permit reimbursement to items which are not covered by the health insurance. This means that your deductible and co-insurance, prescriptions, etc., which are counted towards your out-of-pocket, cannot be reimbursed with this account. Examples of items you might use the Wrap Flex for are vision, glasses, dental, orthodontics, etc. Another reason you might participate in the Wrap Flex is because you are building up your funds in your HSA but need something now, like glasses, dental, etc. The HSA can be used for all things which the IRS allows: deductible, prescriptions, eyeglasses, orthodontist, etc. To use the Wrap Flex, you do have to submit a claim to Employees Group Insurance to be reimbursed for qualified expenses. The HSA is a bank account, so you have to use a debit card or checks to pay your expenses. With the Wrap Flex, you can claim the money for services even if the money is not yet in the account, whereas the HSA is a bank account. You cannot get money out of it if it's not been deposited into the account. If you want to have a health savings account, here are the steps to make that happen. Step 1. Enroll in the High Deductible Health Plan, or HDHP, with EGI or another employer group. Step 2. Open an HSA bank account. Step 3. Fill out the HSA election form indicating what amount to deduct along with a voided check or signed letter from the bank. That form can be found at egi.yo.gov under Active Employees, Applications. Step 4. For state employees, EGI will set up the deduction with the first possible payroll once we receive the election form and it is approved by the state auditor's office. If you are covered by a different EGI entity, your HR office will set up this payroll deduction. Let's finish this training out with the fine print. HSA elections can be changed at any time, but you must not exceed the yearly IRS limit. EGI will cancel your HSA deductions if you change to a non-HDHP. As mentioned, payroll deductions for non-state members are handled by their HR departments. With flexible spending accounts, the state, EGI, is audited by the IRS. With HSA accounts, the employee is responsible for any audit by the IRS. Keep your receipts and your documentation. See irs.gov for full details on health savings account information.